Hello and welcome to this week's episode of Nucleus Investment Insights. Today we're going to discuss whether Labor's catching an economic hospital pass. On the surface, the economy looks good with the lowest unemployment rate for decades. However, the Australian economy is facing significant headwinds with rising inflation and rising interest rates. Many households are starting to feel these cost pressures already, and it only looks like this will accelerate as interest rates rise. To be fair to Labor, there's many things that are out of their control, but the question is whether voters will blame them anyway. As a change, we're going to discuss the investment implications throughout the episode. So my name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today on the show, we have David Lewellyn Smith, who's our Chief Strategist with a distinctly global macroeconomic flavour. Dave, thanks for joining us.
Pleasure.
And also want to welcome our Chief Economist, Leith van Onselen, who goes by the name of the Unconventional Economist. Leith, welcome also.
G'day, Sam. G'day, Dave. Hello, everybody.
Thanks, gentlemen. So just a quick housekeeping reminder before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform as our show's available on all the majors. And for those of you listening live, feel free to drop your questions in the YouTube live stream chat and we'll do our best to answer them during the show. So now that we've got that bit of housekeeping out of the way, we'll get started. So Leith, I'll hand it over to you to lead us away.
Yeah, thanks, Sam. Look, as Sam mentioned in the introduction, the Labor Party is coming into office, obviously, with the economy in a superficially good position. We've got the lowest unemployment since the mid-1970s. The underemployment rate's the lowest it's been since about 2008. We've got record high employment to population ratio, record high labour force participation. Pretty much the only thing that's not firing on all cylinders when at least it comes to the labour market is wages, which are still tracking around their pre-pandemic level, but are at least going up. Now, what I'd argue is that the problem when you come in with such good figures is that there's really only one way to go, and that's down. Obviously, we've got a cost of living crisis across the economy whereby obviously petrol prices are soaring. We've got rents going through the roof at the rental vacancy rates at its lowest level on record, and rents are rising double-digit pace. We've got pretty rampant food inflation, which everyone sees when we go to the supermarket. And the problem for Labor is that the electorate will expect Labor to solve these problems, and part of it is its own making because it did run on a cost of living campaign over the election, and obviously Labor's also facing a sharp rise in interest rates, which is going to add to cost of living pressures even more through higher mortgage rates. Now, I'd argue that most of the factors that Labor's facing are actually out of its control. Obviously, we've got international imported inflation through petrol and the like, and also obviously building materials and all those sort of input costs. At the same time, Labor's also the interest rate lever is also with the Reserve Bank of Australia, so it doesn't really have a whole lot of control there. Interest rates are set independently by the RBA, so Labor's pretty much in a price taker position here, where it's basically all these drivers are out of its control. But being the new incumbent government, it also risks being blamed for obviously the cost of living pressures and any deterioration in the economy. I'll add that the outlook for the economy going forward is obviously going to be very poor with interest rates on the rise. If we believe the median economist forecast, the cash rate will peak at around 2.5% from its current position of 0.35%. The financial markets are even more bullish. They think the cash rate is going to peak at around 3.5%. And if that comes to fruition, the typical mortgage holder is facing a 50% rise in their monthly mortgage repayments. Now, given that household consumption makes up more than half of Australia's growth, you could conceivably have a situation where household consumption collapses because households are, paying a lot more money into their mortgages, which means they've got less money to spend elsewhere. But also, if the Reserve Bank's too aggressive and they raise interest rates too far, we're also looking at a house price, deep house price correction or maybe a crash, which also risks smashing consumption even more through the wealth effect. So, as Sam so eloquently put it, the risk for Labor is that it's going to get blamed for a downturn that's really not its doing, and this risk playing into a theme of Labor being a poor economic manager, which is pretty much what happened. Which is the line that the Liberals have run for pretty much 20 years, from the Howard era to the Gillard-Rudd era after when the global financial crisis hit. I do see parallels here to the GFC, whereby Labor's come in sort of late cycle, just ahead of a downturn, and then it does risk holding the ball when obviously the proverbial hits the fan. And I can't think of a lot of things that are much worse for a government than facing a whole lot of angry households who are obviously angry about the poor state of the economy, cost of living pressures rising, and the value of their biggest asset falling in value, i.e. house prices. So I guess a lot will depend on how aggressively the Reserve Bank of Australia tightens and whether it overshoots, as well as obviously what happens externally. I'm a little bit nervous on this front because I'm watching the canary in the coal mine across the pond in New Zealand, where we're actually seeing the Reserve Bank of New Zealand tighten hyper aggressively, which I think is going to lead to a calamity over in New Zealand. Just yesterday, the Reserve Bank of New Zealand forecast that its cash rate is going to peak at nearly 4% after it's just risen to 2%. And this is in comparison to almost 0% cash rate only a year ago. And that will see the New Zealand's mortgage rates basically double over that time. And I think Australia, if the Reserve Bank of Australia does overshoot, could face a similar set of circumstances, which will smash the economy, smash house prices, and ultimately could smash Labor. Dave, what are your views on this?
Well, firstly, I agree with your summary. Vis-a-vis the timing and the risks, absolutely. I'd say there are two mitigating factors, or probably three, that may prevent that worst case outcome. The first one being global goods prices have peaked, and that's one of the major cost of living pressures you refer to that's outside of Labor's control. The whole supply chain pressures globally are now slumping into, the tension in them is easing back really quickly, in part because China's had its COVID accident things, but it's actually more than that. Goods consumption is slowing. Real goods consumption, that is volumes, is slowing at a good clip in the US. The European consumer has been hit by its energy shock, and so it's down there as well. And then, of course, we've got combined property COVID downturn in China. So, I mean, those 6 shocks we've described for the last few months in the potties have topped out global goods prices. So there is some deflation coming on imported goods, which will help, some of those imported inflationary pressures. I still think as well that the Fed can't stop tightening, even though the US economy is clearly slowing now, and inflation has a peak there as well, though it remains, kind of pretty strong. I think the Fed can't stop tightening until it at least breaks oil down. Otherwise, I think it risks, if it were to pivot away to easing at this point, even just turning neutral, it risks sending commodity prices completely balmy and just delivering a new round of demand destruction to the global economy anyway. So it's in a bit of a catch-22 position. So it could either give the world an inflationary negative growth shock or just a deflationary one. It would obviously prefer the latter. So I don't think it's done tightening. So there's probably still a commodities shock coming as well, which may add to your case, Leith, of making life more difficult for the economy. But it will also feed into lots of goods deflation. My base case is still that we get some form of pretty decent global recession before really kicking off before the end of this year, and that's a time frame in which Labor could probably be blaming the government right up until prices start to fall, and then claim victory, even though they've actually done nothing in either sense. It wasn't their fault to begin with, but they'll claim the victory anyway. And so there'll be relief on cost of living pressures, I guess what I'm saying, especially through 2023. And so that's one mitigating factor. And now the other one is because of the sort of Morrison government bumbling on visas, the Australian recovery post-COVID sort of ran about 6 months behind the global one. And so we have a bit of scope for the RBA in particular, but for everybody to kind of watch this play out overseas before they get to tightening too quickly. Now, the RBNZ hasn't had that problem, so they're on the move. Yep. And we know that the RBA has already turned hawkish, but if they've got any sense, they won't track the RBNZ. They'll go in 25 basis point steps, and they'll watch how global inflation comes off, assuming a global recession, and so not go to 50, brackets of 50 basis points, and not front end load it too much. So there's some hope, therefore, that the RBA won't overcook it, because we've got this sort of 6 month lag behind a lot of the global economy, just through good luck, well, actually through bad management that's turned into good luck. And so, we'll have to see. They are starting to sound quite hawkish at the RBA, but to me, it's odds on at this point that the last hike and maybe the next few, they'll probably get a few more away, look more like its ill-fated campaign, in early 2008.
And it had to quickly reverse.
And had to quickly reverse, or indeed just fell way short of what everyone was forecasting.
And mate, that's pretty much the nub of it, isn't it? Like I know Dave and I have talked heaps privately. We're obviously written on the blog that we think the median economist forecast and the market forecast for interest rates is delusional.
Yes.
Pretty much the only commentator we think talked any sense on this is Gareth Ed. The head of Australian economics at CBA tips them much. And actually, Chris Joy is talking a lot of sense as well. Those guys are pretty much the only ones that are talking any sense, thinking that the cash rates not going to rise really by more than say 1.5 to 1.5%.
Yeah,
and even Gareth Ed said that he thinks that's too high, but he thinks if the RBA could overshoot. Whereas all the other economists are tipping more 2.5%, and the markets are obviously tipping 3.5%, and that's where it's disastrous for Labor if the median economist forecast, or even worse, the market's forecast comes to fruition. But I think they'll be stopped out way before that. I think Dave does too, obviously, and because of that, it wouldn't be as disastrous for Labor. So I guess my whole doomsday scenario thing is based on the median forecast. Is based on what the forecasts are saying at the moment. Which I don't think I'm hoping. I don't think the RBA would be that stupid. And as Dave said, also, given we're behind the curve, if central banks elsewhere start reversing and there's a global recession, the RBA wouldn't have got to that point yet, and they can stop out earlier. So
and you can see that coming in the US already. Like they've done like 150 basis point hike after a 25, or I think. They're probably locked in for 2 more 50s, regardless of what happens. But the long end of the curve there has rolled in terms of bond yields, and their terminal rate, like, the expected high for the tightening cycle, has started to drop. Like markets saw it at, I can't remember, maybe 3.5 or so, but it started to drop at a pretty reasonable clip. And so markets are starting to reprice exactly this scenario, at least in the US, where this is all more advanced by 3 to 6 months. And we should mention as well, the extraordinary fixed rate mortgage reset.
Oh yeah, massive.
Got under here.
Half a trillion dollars. Yeah,
yeah. Like it's like 20 to 25% of the total mortgage book of the country
over the next 18 months to 2 years.
Yeah, is going to reset from 2% and sub 2% mortgage rates that were all snapped up during the COVID recessions, when the RBA was buying or was using yield curve control and fixing 3-year rates very low, and they've now blown out to what, 4.5, Leith?
Yeah, well, yeah, no. The average discount variable mortgage rates about 3.8, 3.9 now.
Right. But
obviously
the fixed rates are like,
no, fixed rates are gone. Fixed rates are double or pretty much almost double what they were.
Yeah.
So
but anyway, that $500 billion is going to reset at nearly 4%.
Yeah. So basically, what Dave's saying is, if you took out one of these cheapo mortgages during the height of the pandemic, you're looking at a double of your mortgage rate, whether you switch from fixed to fixed or fixed to variable.
Yeah.
At least
double.
And
that's
could be more
before the RBA does anything.
Yeah.
So I mean that is a very heavy duty tightening that's built in. I think that's the key reason for why Gareth Baird at CBA is making sense, because he does privilege that in his analysis, whereas I think a lot of the other economists are really underrating the impact of that. I mean, it's literally a quarter of Australian mortgages are about to be very onerous indeed. So that, I think, also will inject some caution into the RBA. Now, we've also, it is worried about wage prices, but as Leith said, the official, the wage price index is still, what,
2.35%.
2.35, pre-pandemic levels, clearly trending upwards, of course, and a lot of private surveys are indicating red hot wage pressure, but a lot of those as well have become quite unreliable in recent years, for reasons that are not entirely obvious, to be honest, but they've certainly become a lot more volatile than the underlying official numbers, and so they overshoot big both ways, up and down. And so, we are going to see some more wage growth, and it should accelerate from here. But I don't think the RBA needs to panic overly on that either, especially if it's starting to see reasonably strong signals of an approaching downturn, which, we are seeing. And we're at the headwaters of that, and that's only going to intensify over the next quarter.
And there's also an inbuilt, I guess, institutional headwind of wage growth, in that the superannuation guarantees tip to rise 0.5% every July 1 for the next several years. So that, if you believe the Grattan Institute and the RBA's modelling, that should subtract basically 80% of that rise gets taken off wage growth.
Yeah,
so,
right. Yeah.
So it's just one of these sort of built-in.
What is it? 50 basis points per annum for a few years
until it gets to 12%. So it's currently 10%. So next 4 years.
So 4 years, shit. Right.
Yeah. So that's that alone should take, if you believe the modelling, 0.4%, shave 0.4% off wage growth every year.
Every year. Yeah.
Yep.
Which
is significant.
Yeah. Absolutely, it is.
So I've obviously, I've campaigned pretty hard against doing that, but I guess in an inflationary environment, it's probably not a bad thing in some ways.
Yeah, maybe so. There are probably two scenarios then for the economy and for labour. I'm trying to sort of boil it down to probabilities, but let's describe the scenarios first. It's the end of cycle shock that you described, Leith, and whatever the headwinds that there are globally, they're not enough yet. The Fed has to keep tightening. Maybe the Chinese COVID crisis eases somewhat and it rebounds and gives a little bit more momentum to global growth. And the Fed's forced higher, and then the US plunges into recession and drags China and Europe with it. And we get a hard landing globally, and Australia is just dragged into that by falling commodity prices and falling asset prices. And we would risk recession in that scenario, probably more like in 2023 here. Still a fair bit of momentum in things here, both private sector and public. We shouldn't forget there's quite a lot of public infrastructure investment going on this year, like pretty strong growth, which has lagged stimulus out of the COVID period. And that actually starts to flatten out and fall next year. So that'll be another support that's removed. So the hard landing scenario, but there is probably a better prospect of a soft landing here than there is elsewhere, I would suggest. I wouldn't necessarily make this the base case, but let's say we get a reasonable correction in commodity prices, but because of the Ukraine, will they really revert to mean? I'm talking about maybe oil drops to $70 and the various coals come off maybe by 40%, but they're still historically very high prices, and so it's fine for the budget, and national income doesn't take that big a hit in Australia. And because of the lag we've got on this developing sort of global recession, the RBA does get tipped off and stops hiking, and relatively soon. Australian house prices don't fall that much during this big mortgage reset, and so consumption is okay. And in that scenario, you would get, kind of a big shift downwards in the external inflation drivers, both in terms of energy and goods prices. So 2023 would shape as a really big deflationary year, and the cost of living would come down a lot. And if Australia came through that with a soft landing,
Labor look good.
Labor, yeah, and wages don't pull back that much. House prices don't fall that much. The RBA is on hold. Labor looks good, yeah. So there is,
and then it'll be a bit like in the GFC. Australia coasted through the global financial crisis compared to other nations.
Yes,
but obviously, I think the narrative can't be run the same now. But back then, it was focus on Labor's spending, school halls, waste, blah 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 blah. Right, blowout in the debt.
Yeah,
I don't think that'd necessarily jive this time around, given that the coalition was obviously in government during the COVID pandemic when debt ballooned as well. So
yes,
I think voters would be more receptive.
Receptive to
receptive. Sorry.
Yeah, to fiscal stimulus. You mean? Yes, absolutely right. So I think, like, even in the hard landing scenario, where maybe we were in recession, I don't think it would be overly deep. It depends. I mean, if the RBA is silly enough, it's really about the RBA. Isn't it?
It is. The RBA is basically holding the bat.
It is. If they're silly enough to chase this, then we will get a nasty recession.
And I sort of,
and Labor will wear it. But,
I know. I always look at New Zealand. I mean, I've been talking about New Zealand, but it's interesting in that New Zealanders have really turned against Jacinda Ardern. Like she's gone from being the saint to, right down here in the polls, like lagging way behind.
So who's leading there now?
The National, I can't remember his name. It's a bloke. So the National Coalition, which is basically National Act, like the Conservative side. If they did like a coalition versus Labor and the Greens, the coalition's way ahead now. And basically the Kiwis are getting really restless with Jacinda Ardern because of all these factors, effectively. And I'm looking at the RBNZ, like she's kind of helpless in a way. Unlike Labor, though, she has been in government, whereas Labor's a new one, so they got a fresh coat of paint, and that's always good. But it's interesting watching Kiwis go from a year ago loving her to hating her.
How many elections has she done? Is she still in first term or the second term? Second
term, yeah. But she had a stomping like the record support only about a year ago.
Right.
And now it's gone the other way, and they're now got the baseball bats out for it. So, but again, she's a little bit like us. She's captive to the RBNZ. The RBNZ's become hyper aggressive on, and their statement yesterday, and the statement of monetary policy was as hawkish as you could believe. Like I could actually shock the bank economists and everything how hawkish they were. And I think if they followed through with what they're saying, well, then New Zealand's, housing market's going to crash. They're even more probably vulnerable than us. And then
they had a bigger run up, didn't they, during COVID?
Oh, massive. Yeah. It's more inflated, although their household debt's arguably a bit less. But they're incredibly. They've had a lot more highly geared mortgages than us. Like their debt to income ratio is above 6, so it was about a third of all mortgages last year. It's insane. So definitely worth watching what happens in New Zealand. But then again, as Dave said, New Zealand's 6 months ahead of us as well. So they started tightening in October last year. So about 6 months ahead. And there is hopefully the good scenario for us is, in some ways, if the world goes into recession early before the RBA's tightened too much, it might actually end up being good for us, I guess, because it could cut the RBA out early. We'll have to wait and see.
Yes, I mean, I guess nobody's going to see it as good, but in reality,
sorry, good politically, maybe.
Yes,
I'm talking about.
Yeah, and that as discussed, there is an outcome there that makes Labor look pretty good with falling standard of living, falling goods prices, wages okay. I imagine services inflation will still be a bit sticky, especially rents and things, but. Building costs and stuff will all be falling a lot.
Yeah.
Steel prices globally are starting to come off, and it would certainly all accelerate if we get a decent commodities bust. So, and then, wages would probably be a little higher than they were pre-pandemic. So we might actually get some real wage growth, I guess.
Yeah, and also remember, Albanese has come out in very strong support to increasing minimum wage and award wages. So that's basically a quarter of all employees are on 2% are on the minimum wage, and another 23% are on award wages, which are linked to the minimum wage.
Yeah.
And Albanese has come out saying that he wants them to go up in line with inflation, or 5.5%, which is basically slightly above inflation. So if that happens at the same time as you got goods deflating, the wages won't feed. The wages feed into inflation will be more than offset by the falling goods.
Yeah.
So you can argue the whole. We've got real wage growth.
Yes. Absolutely.
Which should play really, really well.
So there's a decent prospect of that. So I guess, in short, answering your own question, is Labor being handed a hospital pass? Maybe, but maybe not.
Yeah. Well, I think they are if the median economist and market's correct.
Yeah.
In their
yes.
Like
in conventional terms, they look screwed, but it's probably they're very likely to be wrong.
Yeah, that's right. And look, this whole notion that you're going to have the cash rate go 2.5% to 3.5% is just. I mean, I believe it's bonkers. Dave believes it's bonkers. Some others believe it's bonkers. But if that happens, well, then I think Labor are screwed. But given I don't think it will happen, less screwed, or not screwed, or maybe if cards fall the right way, maybe they'll come across as being the saviors, a bit like they were during the GFC before.
Yeah.
Like Labor's problem during the GFC was it came fairly early in its term. It looked good at the start. The first 2 years, they were very popular. We sailed through it. Australia was one of the only countries to avoid recession because we obviously ramped up. That was really more because we had ramped up immigration. But in the last year of their term, once everyone became complacent with that, it then got turned around to their reckless spending and school halls waste and their installation waste and blah, blah, blah.
Well, we had the commodities investment super boom.
That's right, yeah. Yeah.
So the RBA was busy making room for that, which meant the East Coast had heavily falling house prices. But I don't think we'll see a rerun of that for commodities, resources investment. We're going to see a hodgepodge of investment in some areas, especially, the new age commodities in lithium and copper and things like that people see as essential for the energy transition. But there's not going to be anything for coal. There'll be nothing for iron ore. If they get an LNG project up, I'll be surprised, because for various reasons, a lot of LNG buyers have enough for Australia and would rather diversify elsewhere, especially to the US, but also Qatar. There's a lot more volumes coming on over the next 3 to 4 years. We've exhausted the best of our LNG project. So we might get 1 or 2 backfilling projects up on the North Shelf, which would, might push the RBA a little further, but I don't foresee anything like the resources investment boom that we had post GFC, which is really the driver of a lot of household dissatisfaction with the government of the day, because they were the ones that were being forced to retrench to allow the mining investment to take place without blowing up inflation. So I don't see a rerun of that.
No, and obviously Australians are more comfortable with debt and deficits now. I don't think people care anymore, to be quite honest with you. It was a bit of a sort of boogeyman back when the Gillard-Rudd governments were in. Now we've obviously just sailed through the pandemic, or lived through the pandemic, and we've seen, and I think people are understanding that it's not really that big a deal. So
yeah, I don't think it's entirely gone, but I think surplus obsession is gone.
Yeah,
like getting back to surplus as some critical, macroeconomic lever, that's dead and buried. Chalmers was out yesterday saying he wants to run the budget fairly tight, no more new spending after the election promises and things, and that makes sense if you've got rising interest rates and everything.
Yeah.
But as you say, like getting to surplus across the cycle, I think that's finished, and to be perfectly honest, that's a good thing. But then at the same time, I don't think we've swung entirely to the pole of MMT.
Oh, no, but yeah, I guess what I'm saying is if there's an accident and like the world does go into recession and Labor's got to, obviously the RBA's got to reverse, and Labor's got to pump prime and stuff. There's not going to be
they'll have no issue with that.
Yeah, no. Exactly. Yeah. Whereas during the GFC, the coalition ran the whole debt and deficit mantra. The coalition government, we paid back the debt. Labor's put us back in debt.
Yeah, no, they can't. They
can't run that line. Partly because Labor can just go, well, hang on, 2 years ago you did this.
They've also got the small problem of the coalition does of whatever it says, it's going to come out of the mouth of Peter Dutton. So that's going to be a hard sell to begin with.
Mate, never say never. Look.
No, I know. We've learned that lesson.
Yep. I never thought Tony Abbott become Prime Minister. I never thought Albo would become. I thought both of them were placeholders.
Yeah.
And look, so it could be the trifecta.
Yeah. Absolutely. It could. I mean, there are some very, very big, very serious challenges confronting Australia, not just economic, especially geopolitical. And if Labor, botches that in the Pacific or elsewhere, then coalition hawks, will suddenly be very popular again. So, there are paths for the coalition to come back, even though they've done themselves some pretty serious harm.
Yeah, never say never.
Yeah, but never say never. Absolutely no.
Yeah, I think what it's shown is like Australians are, more at the state level, I guess. We've seen, one-term governments several times now, and I'm definitely not predicting that like the coalition is going in the next election. I think it'll be at least 2 terms, but you just never know if there's a big enough accident. If cards don't fall Labor's way, you never know.
Yeah. No, I think that's right. I think the population's been flopping around, changing parties until they get them to do, to fix themselves. the both offerings on both sides have been so weak. And, now we've got the Teals. It's the new attempt to do that.
It's also worth pointing out.
What is the ultimate balance in the Senate? I think it is Labor Greens controlled, is it?
Yeah, but I guess the warning sign for Labor is that they won the election. They got a stomping majority, but their primary vote was abysmal. So it was under a third, which I think is the lowest for
it's 909 or something. 909.
Yeah, something like that. It's terrible. It's terrible. It's
100 years.
Yeah. Yeah, it's basically the lowest in, I guess, modern, post-war history for a elected government to get that few primary votes. And what that tells you is that this was more a vote against Scott Morrison than it was a vote for Labor.
Yeah,
that's the way I read it anyway.
No, I think that's right. So if they do make some blunders, that's not a strong base.
But then again, I don't know if Peter Dutton's the man they'd swing to. That's for sure.
Yeah, well, I mean, I guess the thing on that front that's all just a little bit scary for the Liberal Party supporters is, Barnaby Joyce and Peter Dutton are, two. I mean, that is like a dream team from hell for the urban electorates.
Yeah.
Like they're going to be horrified at that duo.
But at the same time, though, if you look at the UK, Boris Johnson won with Londoners and those sort of, I guess, elites hate Boris Johnson. So, that's what I understand. So you never know. Like no. It could be the Australian equivalent of the flyover states that ends up swinging to the coalition. If it might annoy the latte left in Melbourne and Sydney, but so yeah, I mean, look, this is all just navel gazing. Who knows? But I don't think Labor certainly can't be complacent, and I know you're not saying they should be or they would be, but
no,
you never know.
No. All right. Well.
Yeah, guys, we've got a viewer question that's come through from Marcus. So the RBA, it's supposed to be independent, but he's saying that the RBA is not independent, and there's existing legislative mechanism for the government to set the rate if they wanted to. So I guess the question is, if rates went to where the market is pricing they're going to go to, could Labor actually step in, and do you think would they?
No.
No and no.
And why is that?
Well, I mean, it's a sacred cow
suicidal
of the political economy is the independence of the central bank. The only scenario in which I could see that happening is war. But for some reason, the government of the day felt it needed to nationalise the RBA. It would, but that would, maybe it felt it needed more quantitative easing to help fund its war effort or something of that nature, or some similar scale of shock, which do not appear to be confronting. So
it'd be similar to like the 1975 dismissal when the Governor General booted out Gough Whitlam. I'm not saying it's obviously kicking the Prime Minister's bigger, but that was perceived as this huge historical anomaly, which, yeah, sure, the legislation was there to allow it at the time, but it was never sought as being something that they'd actually do. And I think this is a kind of similar sort of case. As Dave said, it's probably there written that way for these extraordinary circumstances like war or something like that. And I think, honestly, if Labor did that, they'd probably be booted from, it'd be just such a travesty.
We are going to get an RBA review, though.
Yeah.
Which will be a good thing because its forecasting record in particular has been abysmal for a long time, which has led it to overdo a couple of cycles. both on the downside and up. So we'll see some pressure on the RBA to reform and improve, but that's about as far as it'll go. And it remains to be seen how much that pressure will even come to bear if we have an inquiry. Australia has a terrific history of brilliant inquiries and then doing nothing with them. So,
we're the world champions in that.
Yeah. So that's probably about as dramatic as it gets for the RBA.
Okay, nice one, guys. Thanks for that. So now we've got our viewer question of the week. So this is for viewers to have some discussion in the comments section over the coming days. The question for this week is Australia heading for recession? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So just quickly, Dave first, what's your short answer on is Australia heading for recession? And then Leith will get your comments as well.
It's too opaque to give you a direct answer. I'd say probably 50-50 between the two scenarios we described, soft landing and hard. The hard landing being an actual recession, soft landing just being, crappy growth for a couple of quarters down in the ones. So I'd just put that at half, 50-50 at the moment.
Yeah, I'd say maybe. Depends on all these things we talk about, but largely whether the Reserve Bank overdoes it on interest rates. And I think if we would have a recession, there'd have to be a mistake, and it wouldn't be the government's mistake; it'd be the Reserve Bank's mistake.
Yeah, which is plausible.
Yeah, it is. Oh, absolutely, it's plausible. And honestly, I think if the RBNZ, again, I'm pointing to New Zealand, I don't know if I should, but if the RBNZ follows through what they said yesterday in the Statement of Monetary Policy, I think they're going to drive a recession. And they said straight out, black and white in their statement, that they're deliberately, the New Zealand economy is running ahead of capacity, and they're deliberately retrenching the economy to bring it back into line, demand and supply back into line. So, if the RBA end up following through that, which I don't think they will, our pressures aren't quite as bad. Labor, we could end up with a recession, but it'd have to be a mistake.
Okay, thanks for that, guys. That almost wraps us up. So, Dave, just want to thank you for joining us and sharing your views and opinions again on the show.
Thank you, Sam.
And Leith, thanks again also for your economic perspective and your insights as well.
Yeah, cheers, Sam, and thanks everyone for watching.
Cheers, guys. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your financial situation, please go to our website at nucleuswealth.com and you can book a call with myself or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes of content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So from myself, Dave, Leith, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.